Hello and welcome to the Daily Brief Show by Zerodha. Here we cut through the noise and bring to you the most important pieces of news that move the markets. I'm your host Anurag Bansal and today we'll be talking about 4 very interesting stories. First, we'll talk about India's latest inflation numbers and what it means to us. Then we'll move on and talk about what investment bank Jefferies has to say about Jio Financial Services IPO. After that, we'll talk about the SME IPO market and proposals from an editorial article. And lastly, we'll talk about the Chinese GDP and why it matters to us sitting in India. So let's begin by talking about the latest inflation numbers in India. Remember how we discussed the RBI governor's comments on inflation and interest rate cuts in the previous episode? He was right. India's inflation data was released late in the evening on Friday and it rose a little bit. Let me break it down for you in simpler words. The headline CPI inflation rose from 4.8% in May to 5.1% year on year. To give you some context, the RBI's inflation target is 4%. But why did this happen? That is because of food and beverage inflation, which jumped from 7.9% to 8.4%. This spike was mainly caused by a rise in the prices of fruits and vegetables. The prices of staple vegetables in Indian kitchens, which is potatoes, onions and tomatoes, have shot up by almost double digits due to brutal heat waves across the entire country. And it's not just these vegetables, the prices of rice, wheat, mangoes and even coffee has been climbing. However, the interesting bit is that the core inflation, which does not include volatile items like food, beverages and fuel, stayed at 3.1%, which is the same as in the month of May. Now, most experts think that this spike won't last long. The assumption is that as monsoons pick up pace, food inflation will slowly start falling and so will the headline inflation. Now today, the wholesale price index or the WPI inflation data also came in. But before we talk about it, here is a quick refresher on what WPI is for those of you who need it. Look, CPI measures the inflation for households while WPI looks at the price changes of goods sold in wholesale markets. The WPI inflation rose to 3.4% in June as compared to 2.6% in the month of May. Again, this is because of the rise in vegetable prices. But what does this mean for all of us? I'll explain it to you. For starters, if your family has been complaining about expensive fruits, vegetables and coffee, now you know exactly why. Second, with inflation still above 5%, RBI is not expected to cut interest rates anytime soon. The hope is that they might change their stance in October and maybe start cutting rates from December onwards. But unless inflation drops sharply, we are probably looking at rate cuts of no more than 0.75 to 1%. And this means the baseline repo rate will still be higher than pre-pandemic levels. Third, if you are betting on bond yields falling, then this might not be a very exciting time for you in the markets. Based on current expectations, the rally in bonds will probably not be very huge. Now moving on, let's talk about some interesting news around Reliance. Investment bank Jefferies recently put out a report suggesting that Reliance might IPO or spin off its telecom arm Jio platforms. What does this mean? Let me break it down for you. Now I'm sure you know what an IPO is, so I'll skip that part and talk about spin-offs. See, you remember when Reliance spun off Jio Financial Services last year? That is basically a spin-off. A spin-off is basically when a big company separates one of its divisions and creates a separate company out of it. Now why do companies do it? They do it typically to focus on their core business and to get rid of distractions. This also helps them unlock true value in the spun-off companies. And as an investor, if you own shares in the parent company, you get shares in the spun-off company if it is listed in the stock exchange. Now with that out of the way, let me explain something known as the holding company discount. Now this might sound complicated, but trust me, it is really simple. Look, Reliance owns several companies like Jio, Reliance Retail, Reliance Petrochemicals, etc. Now if you add up the value of each of these companies separately, you will get a pretty high total. But when investors consider Reliance Industry as a whole unit, they often value it less than the sum of its smaller parts. And that valuation is called the holding company discount. Now this typically happens because investors think that it is harder for Reliance to manage all of these diverse businesses together. So what does Jefferies' report say about it? See, it suggests two possibilities for Jio. One is a spin-off and the second one is an IPO. For an IPO, Reliance would retain the majority control of Jio. But there is a catch here. It is going to be a huge IPO and 35% of it has to go to retail investors. Now this might make it very hard to get the issue fully subscribed. For a spin-off, on the other hand, Jio platforms would become independent and it would make its value clear and separate from Reliance. Basically, it would help eliminate that holding company discount that we had spoken about earlier. Jefferies analysts think that a public listing could value Jio at a massive 112 billion US dollars, and that is huge. Now moving on to the third story for the day, we will talk about the unreal growth in SME IPOs. See, in FY 2024, about 130 SME IPOs went live on NSE and they collectively raised 4622 crore rupees in the markets, which is a record high. For comparison, SMEs had collected about 2455 crores in FY 2018, so the growth has been unreal here. Now if you recall, we discussed SME IPOs in an episode last week as well. We spoke about how SME stocks and IPOs have fewer regulatory requirements than regular IPOs. This is so that they could raise more capital easily. But instead, now this has led to frauds and scams in the SME segments. To curb this, a few days ago, NSE had imposed a 90% cap on the listing price above the issue price in the pre-open session. Now, in simpler words, that basically means that 100 rupees stocks at IPO cannot list at more than 190 rupees. And this was done in order to reduce speculation and volatility in these IPO listings. Now, because of the spectacular growth in SME IPOs, this became a retail favorite. Some even went to the extent of considering SME IPOs to be a guaranteed money-making scheme. Now, there is a very interesting editorial article in the Hindu Business 9 that talks about this topic. The editors discuss 4 interesting changes that, if implemented, can reduce speculation, scams, and fraud in the SME segment. First, they propose increasing the minimum subscription amount from 1 lakh rupees to 5 lakh rupees. The reasoning sounds fair as well. The 1 lakh rupee rule was introduced back in 2012 to keep away those retail investors who may not be able to bear the risk associated with SME IPOs. But 1 lakh rupees does not seem to be a very big constraint anymore in today's time. And therefore, an increase in the minimum capital would be very important in order to curb these risks. Second, they talk about significantly lowering the 90% limit on listing day gains in the pre-open session. The rationale behind this is that the 90% cap is too liberal and it will attract speculators. And this is true even though 40 of the 130 odd SME stocks that IPO'd on BSE and NSE delivered over 90% returns on the listing day. The idea here is that if a stock is good, it will do well. Third, they suggest that these rules need to be implemented simultaneously on BSE and NSE for them to be very effective. This is because both exchanges have around 300 SME stocks each. If price gain on one platform is curbed, it will only result in speculators shifting to the other one and it will only create more problems. So while all this is only a theory for now, if implemented, this could solve many of the problems that SEBI faces with SME IPOs as on date. Now I'll remind you that this is just Hindu Business Line's opinion and SEBI has not yet hinted or mentioned anything about changing how SME IPOs work. But as they say, where there is smoke, there is fire. Now moving on to the last story of the day, let's talk about China's economy and its recent GDP numbers. In the quarter that ended in June 2024, China expected itself to grow by 5.1%, but they fell short and only managed to grow by 4.7%. Now before we get into the details of the story, let me give you some basic background. First, China does something that most other countries don't. It sets growth targets for itself. Other countries try to create a stable economy, invest strategically, and then figure out how well their approach worked at the end of the year. China, on the other hand, does things very differently. It sets growth targets and then builds its economic policy around reaching them. Now, China's strategic approach has worked beautifully for them over the years. They have been the world's best performing economy for the last 50 years or so. But here is the thing, this approach can also backfire. If you are super rigid and you politically bind yourself to a growth number, you will probably find a way to get there by hook or by crook. And that is where the problem lies. For 2023, China had set itself a target of 5% GDP growth, and it actually did. In that case, there were many reasons why China should not have grown that fast. First, its property sector is in its worst crisis ever. This sector is about 30% or more of China's economy. By the way, this also spread to local governments, because in China, local governments are primarily funded by real estate sales. Second, FDI or foreign direct investments into the country was at a 30-year low. Third, Many overseas markets were trying to reduce their dependency on China because of the negative sentiment around it. And fourth, Chinese consumer demand has been suppressed for many decades now. Chinese people aren't quite buying enough to sustain the GDP growth. Now, that said, it was not that bad either. EV sales, for instance, grew exponentially, but it didn't seem to quite make a difference to China's economy. But all that said and done, at the start of this year, China announced that its GDP growth had been exactly as planned, which is 5.2%. Now, how did they manage this despite all their external problems? Turns out, a lot of it was artificially powered. Let me explain this. First, they approved a $140 billion government bond issue to help their debt-ridden local governments. This again links to the property crisis across the country, as I had already mentioned earlier. Second, they abruptly increased bank lending to the manufacturing sector. And third, they kept struggling companies alive by giving them money and letting them delay their loan paybacks. But here's the interesting thing, this growth was not quite reflected in the lives of ordinary Chinese people. Their net worth had crashed due to the property crisis, youth unemployment was high across the entire country, and employers were slashing salaries. All of it resulted in people cutting on their expenditures and therefore contributing to the economy. So if you look at the bigger picture, China's GDP schemes might have brought some growth on paper for 1 year, but they have probably made problems worse for the long term. For 2024, they set yet another 5% growth target and resumed business as usual. Now, this strategy seemed to work initially as their March quarter saw a growth rate of 5.3%. But in the June quarter, reality hit them very hard. Chinese people did nothing to increase their spending. Retail sales grew at an 18-month low of 2% year on year. Businesses had to slash prices on everything, right from groceries to cars, and home prices fell at their fastest pace in 9 years. Sales declined 19% in just the first half of 2024. Now, even though China's 4.7% growth in the previous quarter might hide a lot of structural problems, a big chunk of it came from strong export numbers. Overall, this growth is actually concealing a lot of deeper and long-term problems in China's economy. All of this puts a lot of pressure on the Chinese Communist Party's third economic planning meeting, which started yesterday. Major changes are definitely necessary, and how China navigates these problems will be an interesting test for its economy. Now, all this while, if you were wondering why this matters to you sitting in India, let me end today's episode with a popular quote. If China sneezes, the world catches a cold. Well, that's all the news I have for you today. I hope you found value in this. I'll see you in tomorrow's episode. Take care and bye-bye.